Hello everyone, it is Victor here, and this is an introduction to investing. Before we get started, please go ahead and give that like button and that subscribe button a click. In the past several videos, we've been looking at personal finance as an equation, specifically as a chemical engineering mass balance, which is in minus out plus generation minus consumption equals accumulation due to budgeting plus accumulation due to investing. We've talked briefly about saving, which is investing our accumulation due to budgeting term, but how much money we invest, and therefore how much we save, has a direct impact on how much we can make from our investments. Let's start by discussing why we should invest rather than just save. This graph shows the inflation rate in any given year, so every year above zero is a year that we experienced inflation. This graph shows the cumulative inflation year over year, so you can see that money continues to inflate over time. This impacts our money's buying power. This graph shows that something that cost $100 in 1969 would cost about $700 in 2019. This means that we need more dollars today to be able to have the same purchasing power as in 1969. On average, the annual inflation rate is around 3%. At this inflation rate, prices will double about every 20 years. This means that a widget that costed about $100 in 2001 would cost about $200 today in 2021. So how can we counteract inflation? We need to help our money grow with time. This brings us to the stock market. If you look at a week in the stock market, it might look something like this. One day the price is low, the next it's high, and low again, and high again. The price fluctuates rapidly such that it's very unpredictable. However, if you zoom out, you can see that on average, the value of the whole market goes up. The line is fuzzy because of all of the day-to-day fluctuations. Then we have these little dips that usually correspond with external factors like the dot-com bubble and the Great Recession of 2008. But on the whole, the value of the market continues to go up. The average annual rate of return is 10% or 7% adjusted for inflation. Additionally, the market has never failed to recover within a few years. This means that even if you invested right before the worst dip, if you weathered through it, you would have still come out profitable. The golden rule of personal finance is this: those who understand compound interest earn it, and those who don't pay it. This is how debt can get out of control so quickly, and how people can make money investing. To understand the effects of compounding interest, let's look at a few scenarios. Let's say that today you went out and invested $3,000 in an index fund. We will assume that we are getting the stock market's average rate of return of 7%. Assuming you're 22 years old right now, that $3,000 would have grown into almost 60K by the time you're 65 years old, or 200K in inflated dollars. That's a lot of growth. Now let's say that you don't invest your $3,000 today, but instead wait 5 years until you're 27. You'll still end up with a lot of money, but it will be worth about 42K instead of 60K by the time you're 65, or 123K in inflated dollars. That's a difference of about $75,000 in future money. Now let's say that you start at age 22, but instead of investing $3,000 and not looking at it until you're 65, let's say that you invest $3,000 every year until you're 65. This grows into about $850,000, or about 2.2 million in inflated dollars. Not bad for $3,000 a year. So how do we ensure that we get a 7% rate of return? This is the ultimate easy investment strategy: buy and hold. This means that whenever you buy an investment, the intent is to hold on to that investment for a long time, on the order of decades. Remember the graph of the stock market's performance? By holding on to your investment long term, you are able to weather through the low points on the graph. Remember, you don't lose money until you sell at a loss. Even if the investment's current value is lower than you paid for it, you won't realize a loss until you sell it. If you don't sell and instead hold on to it, its value will bounce back in time and continue to increase. So what types of investments behave like this? Index funds. An index fund is basically a collection of hundreds or thousands of different individual stocks that follows an index. Some example of indices are the S&P 500, the Russell 3000, or the Dow Jones Industrial Average, which are each a standardized set of companies. Index funds are great because they are reliable, easy, and inexpensive. If you're looking for an index fund, look for expense ratios below 0.08%, ideally between 0.01 and 0.04%. An expense ratio is basically how much it costs to invest in that fund. Another option is to invest in actively managed mutual funds. These are similar to index funds in that they consist of hundreds or thousands of companies, but instead of those companies being dictated by the index, they are handpicked by a fund manager. Because a person is the one picking the funds, these end up being slightly more expensive investments, or realistically, substantially more expensive investments. Additionally, 9 times out of 10, the index performs better than the actively managed fund. So usually active mutual funds aren't as good investments as index funds. However, there are some out there that do quite well and consistently beat the index, but these are few and far between. Also, I would just like to point out here that actively managed funds are much more expensive to invest in, about 10 to 50 times more expensive. This is because the fund manager is paid a cut off the top of the investment. Just keep this in mind if a financial institution is trying to convince you that an actively managed fund is the superior option, because at the end of the day, they are trying to sell you a product. Okay, with that said, you can invest very inexpensively online through many different institutions. I've listed out a few starting points here. I really like Vanguard and would recommend you start there. They have a lot of very cheap, good index funds, and their website is pretty easy to navigate, so they make investing very easy. I want to take a brief moment to mention a few things not to invest in, at least not at first. The first one is high expense ratio mutual funds. Some can go upwards of 2% compared to 0.04% for index funds. Additionally, individual stock investing is much riskier than index or mutual funds because the stock's performance is entirely dependent on a single company. There are some very successful individual stock investment strategies out there, like value stock investing, but these strategies are usually quite time intense and often require practice and some level of industry expertise. I would strongly recommend against individual stocks, at least at first. Finally, as a beginner, you want to stay away from derivatives like options. Remember, never ever invest in something you don't understand. To summarize briefly, inflation makes your money worth less over time. However, by investing, you can help your money grow year over year. This is the only way to not let inflation eat away at your savings. Finally, when you invest, use the buy and hold strategy to invest for the long term to ensure you come out profitable. Thank you all so much for watching. Please consider liking and subscribing, and until next time.